Imagine two friends. One spends the next 20 years proudly telling everyone, "I own property." The other quietly buys stocks every month on his phone while sitting in traffic. 20 years later, one of them is financially free. The other still feels broke. Now here's the strange part. From the outside, both looked smart. Both invested. Both avoided wasting money. Both built assets. But one simple mathematical difference completely changed their future. And most people never notice it, because when people talk about investing, they usually talk emotionally. My uncle became rich from real estate. My cousin doubled his money in stocks. Property is safer. The stock market is gambling. But almost nobody sits down and asks the real question. What actually makes more money over a long period of time? Not emotionally, not culturally, not based on random success stories. Just the math. And once you understand the real math behind real estate and stocks, you start seeing wealth differently forever. Because the biggest difference between rich people and everyone else isn't income. It's understanding how assets behave over time. For decades, real estate has been seen as the adult investment. Buying a house feels tangible, safe, respectable. You can touch it, walk inside it, show it to people. There's something psychologically comforting about owning land. Humans have always associated land with power and security. Even thousands of years ago, kings fought wars over territory. Today, people still think the same way, just with mortgages instead of swords. And that emotional feeling matters more than most people realize, because humans don't just buy investments for returns. We buy investments that help us feel safe. That's why many people would rather buy a tiny apartment they can barely afford than invest consistently in stocks, even if the numbers suggest otherwise. Meanwhile, stocks feel abstract. You can't physically see your shares of a company. You open an app, and numbers move up and down all day. That uncertainty scares people. And psychologically, humans hate uncertainty more than almost anything else. In fact, behavioral psychologists discovered something fascinating. People feel the pain of losing money almost twice as strongly as the pleasure of gaining it. That means if your stock portfolio drops 20%, your brain reacts almost like an emergency, even if you logically know markets recover over time. Real estate doesn't create the same emotional panic because prices move slowly. If your house value drops, you usually don't get a notification every 5 minutes reminding you. But if stock prices flashed on giant screens outside your home all day, most people would panic constantly. And this is where things become interesting, because people often confuse emotional comfort with financial performance. Those are not always the same thing. Let's simplify this with two imaginary people. Meet Sarah and Daniel. At age 25, both want to build wealth. Sarah buys a rental property. Daniel invests in stocks. Now, most people immediately assume Sarah is making the smarter move. Why? Because buying property feels serious. It feels like progress. But let's actually look at the numbers. Sarah buys a $300,000 apartment. She puts down $60,000 and takes a mortgage for the rest. At first, this sounds incredible. She controls a huge asset with relatively little money. This is called leverage. And leverage is one of the biggest reasons people become wealthy through real estate. If the property rises 10% in value, the apartment becomes worth $330,000. That's a $30,000 gain. And remember, Sarah only invested $60,000 herself. So emotionally, it feels like she made a 50% return. Amazing, right? Well, not exactly. Because people often forget the hidden math of real estate. The mortgage, interest payments, repairs, property taxes, maintenance, insurance, vacancies, agent fees, legal costs. Real estate returns are usually much messier than people think. A property can look profitable on paper while quietly draining cash for years. And here's something many people don't realize. A lot of real estate success actually comes from forced saving, not magical returns. Think about it. Most homeowners build wealth because the mortgage forces them to consistently put money into an asset every month. It's basically a financial discipline machine. If those same people invested consistently into stocks for 20 years, many would also become wealthy. But psychologically, stocks are easier to quit. You can stop investing anytime. Selling stocks takes 5 seconds. Selling a house takes months. That friction matters. Sometimes wealth isn't built by the best investment. It's built by the investment that prevents you from making emotional decisions. Now let's look at Daniel. Daniel invests the same $60,000 into a broad stock market index fund. Then, he consistently adds money every month. No tenants, no leaking roofs, no midnight phone calls, no repair costs, just ownership in hundreds of businesses. And this is where people misunderstand stocks. When you buy stocks, you're not buying random numbers on a screen. You're buying pieces of real companies, companies that sell phones, build software, move goods around the world, create medicines, own factories, run payment systems, build artificial intelligence. Over long periods, great businesses tend to grow because human productivity grows. And historically, broad stock markets have returned around 8% to 10% annually over long periods. Now here's where the real math becomes powerful. Compounding. Compounding is probably the closest thing finance has to magic, because wealth doesn't grow in a straight line. It grows exponentially. At first, growth looks tiny, almost disappointing. Then suddenly, everything accelerates. Imagine planting a tree. For years, it barely looks different. Then eventually, the roots become massive underground, and growth explodes upward. That's compounding, and most people quit before they reach that phase. Let's say Daniel averages 10% annual returns. At first, the gains seem small, but over decades, the portfolio starts growing faster than his actual contributions. At some point, his money begins working harder than he does. That's the real goal of investing. Not quick profits, not showing off, not looking rich. The goal is building a system where your assets grow faster than your labor income. And this is where time becomes more important than intelligence, because the market rewards patience more than brilliance. Now, real estate compounds too, but often in a different way. Real estate wealth usually grows through 3 things: property appreciation, rental income, and leverage. Stocks mainly grow through business growth, reinvested profits, and compounding. Both can create enormous wealth, but they behave very differently psychologically. Real estate is concentrated. Stocks can be diversified instantly. If Sarah owns one apartment, her entire investment depends on one location, one neighborhood, one local economy, one property. If something goes wrong there, she feels it directly. Daniel, on the other hand, might own tiny pieces of 500 companies across multiple industries. One company failing barely matters. And diversification is extremely powerful because investing is less about predicting the future and more about surviving uncertainty. The people who survive longest usually win. Now here's where the debate gets even more interesting: liquidity. Liquidity simply means how quickly you can access your money. Stocks are extremely liquid. You can sell them instantly. Real estate is slow, and this changes human behavior dramatically. When markets crash, stock investors panic because they can instantly sell. Real estate investors often stay calm because they physically can't react as quickly. Ironically, the inconvenience of real estate sometimes protects investors from themselves. That's a weird psychological advantage. But there's another side, because liquidity also gives freedom. If Daniel suddenly needs money, he can sell part of his investments. Sarah can't sell her kitchen. Real estate is powerful, but inflexible. And flexibility matters more than people think, especially in uncertain economies. Now let's talk about something people rarely discuss honestly: lifestyle inflation. This destroys more wealth than bad investments. As people earn more money, their spending quietly rises too. Bigger apartments, nicer cars, luxury vacations, expensive restaurants. And many people buy real estate emotionally instead of mathematically. They buy properties slightly above their comfort zone because ownership feels prestigious. Then the mortgage controls their life for decades. A house that was supposed to create freedom creates financial pressure instead. Meanwhile, someone renting modestly and investing aggressively might quietly become wealthier over time. This is psychologically difficult for society to accept because humans judge visible wealth. A large house is visible. A stock portfolio is invisible. That's why some wealthy people look broke, and some broke people look wealthy. One owns cash-flowing assets. The other owns expensive liabilities disguised as status symbols. And social pressure massively affects financial decisions. People often buy homes because they fear being judged. At some point in life, everyone starts hearing the same question. So, when are you buying a house? Almost nobody asks. So, how large is your investment portfolio? Society celebrates visible assets more than invisible wealth, and this changes behavior. Now here's the important part. This doesn't mean real estate is bad. Far from it. Real estate has created enormous wealth for millions of people, especially when used intelligently. Rental income can become powerful passive cash flow. Leverage can accelerate wealth creation dramatically. Tax advantages can be significant. And inflation often helps property owners because debt becomes cheaper over time, while property values and rents may rise. But the internet often presents real estate unrealistically. People see social media clips about passive income without seeing the debt stress, market risk, maintenance headaches, or years of slow growth behind the scenes. And stock investing gets misunderstood too. People think investing means day trading, watching charts, predicting crashes, picking hot stocks. But historically, most professional investors fail to consistently beat simple index funds over long periods. That's the crazy part. Sometimes the boring strategy wins. Slow, consistent, emotionally controlled investing, not excitement. And this leads to one of the biggest truths about wealth building. Most wealth is built through behavior, not information. The average person already knows what they should do. Spend less than they earn. Invest consistently. Avoid emotional decisions. Stay patient. The difficult part is psychological consistency, because humans are emotional creatures living in a world designed to trigger impulsive behavior. Everywhere you look, someone is selling urgency. Get rich fast. Buy now. Don't miss out. But real wealth usually grows quietly, almost boringly, like watching paint dry for 15 years, then suddenly realizing the wall became incredibly valuable. Now let's zoom out and look at the deeper math behind why different people succeed with different assets. Because the answer is not simply stocks are better or real estate is better. The real answer is much more uncomfortable. The best investment depends less on the asset and more on the investor's behavior. Some people are naturally better stock investors because they can emotionally tolerate volatility. Others panic during market crashes. Some people are excellent real estate operators. They understand locations, cash flow, tenant management and negotiation. Others hate dealing with people and maintenance problems. And this is something personal finance gurus rarely admit. An investment only works if you can stick with it long enough. A mathematically perfect strategy is useless if fear causes you to quit halfway through. That's why psychology matters so much in finance. In fact, many investors destroy their own returns by reacting emotionally. They buy when prices are high because excitement spreads socially. Then they sell during crashes because fear spreads socially too. Humans are tribal creatures. We copy behavior around us. When everyone feels optimistic, we feel safe buying. When everyone feels terrified, we feel safe selling. Unfortunately, that usually produces terrible results. Wealthy investors often behave differently. They think probabilistically. They understand uncertainty is normal. And most importantly, they stop trying to look smart all the time. Because the truth is, nobody consistently predicts markets perfectly. Not economists, not billionaires, not YouTubers. The future is messy. So instead of trying to predict perfectly, great investors build systems that survive imperfectly. That mindset changes everything. And here's the deeper lesson most people miss in the real estate versus stocks debate. Your savings rate matters more than your investment choice in the beginning. A person investing 25% of their income consistently into average assets often beats someone investing 5% into perfect assets. Because investing is multiplication, and you can't multiply zero. People obsess over returns while ignoring the amount they actually invest. That's like worrying about turbocharging a car with no fuel. The first stage of wealth building is simple: ownership. Own productive assets, businesses, real estate, index funds, cash-flowing investments. The exact vehicle matters less than escaping the cycle of trading time for money forever. Because eventually, labor has limits. You only have so many hours. Assets don't. That's why wealthy people focus so heavily on ownership. Not because they're smarter, but because ownership scales. Now here's the strange paradox. Both real estate and stocks can make you rich, but neither automatically creates financial freedom. Because wealth is not just numbers. It's control over your time. And many people accidentally build high-maintenance wealth. Imagine owning 15 rental properties, but constantly dealing with stress, debt, repairs, and financial pressure. Are you truly free? Now imagine someone else quietly living below their means, owning a massive stock portfolio, and having complete flexibility over their life. Who is richer? The answer depends on how you define wealth, and this is where money psychology becomes incredibly important. Humans adapt quickly. A bigger house feels exciting for a few months. Then it becomes normal. This is called hedonic adaptation. Your brain constantly resets expectations. That's why chasing status endlessly feels exhausting. True financial peace usually comes from reducing dependency, not increasing appearances. The goal is not looking wealthy. The goal is building optionality. The ability to say, I don't have to. I don't have to stay in a toxic job. I don't have to panic during emergencies. I don't have to rely entirely on my next paycheck. That's real wealth. And ironically, many wealthy-looking lifestyles destroy optionality. Huge mortgages, luxury car payments, lifestyle pressure. People become servants to their own image. Meanwhile, quiet investors slowly accumulate freedom in the background. And freedom compounds too. So, which investment should most people choose? The honest answer is probably both eventually, but not necessarily at the same stage of life. For many beginners, simple stock investing is often easier, more diversified, more flexible, and less stressful. Especially through broad, low-cost index funds, it requires less capital. less maintenance, less specialized knowledge. Real estate can become extremely powerful later, especially for people who understand leverage, cash flow, and long-term property economics. But here's the key lesson. Do not choose investments based on social pressure. Choose based on mathematics, risk tolerance, and behavior. Because the best investment is the one you can consistently hold through uncertainty. And consistency beats intensity in finance almost every time. If you constantly jump between strategies, panic during downturns, or chase trends, you interrupt compounding. And interrupting compounding is incredibly expensive. Remember, most millionaires did not become wealthy overnight. Most simply owned productive assets for very long periods of time. That sounds boring. Because it is. But boring is often profitable. The internet glorifies speed. Wealth usually rewards patience. At the end of the day, the real estate versus stocks debate is actually about something deeper. It's about how humans relate to uncertainty, status, security, and time. Real estate feels safe because it's tangible. Stocks feel risky because they move visibly. But both are simply tools. And tools only become powerful when used correctly. A hammer can build a house or destroy a window. The same is true with money. The real math of wealth creation isn't just percentages and returns. It's behavior multiplied by time. That's the equation most people ignore. Because the greatest financial advantage is not finding the perfect investment. It's developing the patience to let good investments compound long enough to change your life. And the people who understand that eventually stop asking, which asset makes people look rich? And start asking, which system quietly buys me freedom?